First, welcome to our deep dive on the target date fund tax trap. In this video, we'll explore why holding standard target date mutual funds inside taxable brokerage accounts can quietly erode your returns through unavoidable annual taxes. We'll unpack the mechanics behind glide path rebalancing, how distributions work, why the tax bracket illusion is misleading, and how to restructure your holdings for maximum tax efficiency. Stay with me, because by the end, you'll know exactly how to stop the tax bleed and what to do instead. Next, here's our roadmap. We'll start with quick definitions to level set, then examine how TDFs realize capital gains inside the fund and distribute them each year. We'll break down the tax bracket illusion that trips up many investors. Then, we'll move to a practical action plan covering account placement, ETF wrappers, and simple indexing. Finally, we'll test your understanding with quick quizzes and finish with a concise checklist. Before we dive in, an important transition. This content is educational and not tax, legal, or investment advice. Everyone's situation is different, and tax rules can change. Please consult a qualified professional to tailor these concepts to your personal circumstances. Moving on, here's the core issue. Many investors place standard target date mutual funds into taxable brokerage accounts. Because of how these funds operate, you can face unavoidable taxable distributions every year, even if you never sell a share. Those taxes reduce your after-tax return and can compound into a meaningful performance drag over time. Now let's unpack the silent tax hit. Target date mutual funds follow a glide path that steadily shifts from equities to bonds as the target date approaches. This requires rebalancing, which often involves selling appreciated positions. When the fund sells those positions, it realizes capital gains. By law, mutual funds pass through realized capital gains, along with dividends and bond interest, to shareholders each year through taxable distributions reported on Form 1099 DIV. Importantly, you owe taxes in that year on those distributions, even if you didn't sell any shares. There is no deferral option in a taxable brokerage account for these distributions. Meanwhile, this mind map lays out how a glide path works. In early years, the fund holds more equities for growth, accepting higher volatility. As the target date approaches, the allocation shifts toward bonds to reduce volatility and emphasize income. That shift requires rebalancing, selling appreciated stocks, and buying bonds, which creates turnover. In a taxable account, that turnover leads to realized capital gains and other distributions reported on 1099 DIV, requiring immediate taxes. The solutions highlighted include holding TDFs in tax-advantaged accounts, considering TDFs delivered via ETF wrappers for better tax efficiency, or using broad, low-turnover index ETFs in taxable accounts. Next, let's address the tax bracket illusion. Investors sometimes plan to realize long-term capital gains at a 0% rate in the future by keeping income low. However, annual distributions from a TDF in a taxable account stack on top of your existing income each year. If your total taxable income plus those distributed capital gains exceeds the 0% long-term capital gains bracket, you will owe tax that year. In short, future withdrawal strategies do not prevent the current year's distributions from being taxed. Building on that, here's a detailed comparison. Traditional TDF mutual funds often have higher turnover due to the glide path and rebalancing, which can lead to significant annual capital gains distributions, creating yearly tax liabilities in taxable accounts. They are convenient because you can set and forget a single fund. In contrast, ETF wrapper TDFs and broad index ETFs benefit from the ETF structure, where in-kind creation and redemption can flush out embedded gains, often resulting in minimal capital gains distributions. This makes them typically more tax efficient in taxable accounts, though you might trade off some simplicity or need to consider bond placement elsewhere. Consequently, here's a practical placement plan. First, prioritize tax-advantaged accounts such as 401ks, IRAs, and HSAs for target date funds and other bond-heavy or income-generating strategies. Distributions are shielded until withdrawal. Second, in taxable brokerage accounts, prefer ETF wrapper target date funds if available, or, more simply, broad, low turnover index ETFs. Third, place most bond exposure in tax-advantaged accounts, using municipal bonds in taxable accounts only if needed and appropriate for your bracket. Fourth, do most rebalancing inside tax-advantaged accounts or with new contributions to limit taxable events. Finally, review your 1099 DIV annually to monitor distributions and adjust your holdings if the tax cost is rising. To clarify further, this table shows where different assets typically fit best. In 401ks and traditional IRAs, you can hold TDFs, bonds, and REITs without current taxation, allowing distributions to compound. In a Roth IRA, prioritize high-growth equities and specialized strategies to maximize tax-free growth. In taxable brokerage accounts, focus on ETF wrapper TDFs when available and broad index ETFs, which usually have minimal capital gains distributions. If you must hold bonds in taxable accounts, consider municipal bond funds or ETFs, since their interest is often federally tax-exempt, which can improve tax efficiency for investors in higher brackets. Additionally, let's walk through numbers. Suppose your target date mutual fund distributes 2% in qualified dividends, 0.8% in bond interest, and 3.2% in long-term capital gains within the year. On a $100,000 position, that's about $2,000 of qualified dividends, $800 of taxable bond interest, and $3,200 of long-term capital gains, roughly $6,000 of total distributions. Regardless of whether you sold any shares, you will owe taxes that year on these distributions according to your qualified dividend, ordinary income, and long-term capital gains rates. This example illustrates how the annual tax drag appears even in a static portfolio. Furthermore, this sequence diagram contrasts mutual funds and ETFs. With a mutual fund, when investors buy or redeem, the fund may need to buy or sell underlying securities directly, potentially realizing capital gains that are then distributed to shareholders. By contrast, ETFs typically interact with market makers through in-kind creation and redemption, exchanging baskets of securities. This process allows the ETF to offload low-basis shares without realizing gains inside the fund, often resulting in minimal capital gains distributions to investors, which improves tax efficiency in taxable accounts. Next up, a quick knowledge check. Why can holding a traditional target date mutual fund in a taxable brokerage account reduce your after-tax returns? Option A, because TDFs always have higher expense ratios than ETFs. Option B, because TDFs distribute realized gains, dividends, and interest annually, creating immediate tax liabilities. Option C, because TDFs never grow as fast as individual stocks. Option D, because TDFs are not diversified. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. Now for the answer. The correct choice is option B. TDFs typically realize gains through glide path rebalancing and distribute those gains along with dividends and interest each year. In a taxable account, those distributions create immediate tax liabilities that reduce your after-tax returns. Moving forward, here's a second question. Which approach is generally more tax efficient for a taxable brokerage account? Option A, a traditional TDF mutual fund. Option B, an ETF wrapper TDF or broad, low turnover index ETFs. Option C, high turnover active mutual funds. Option D, holding taxable bond funds with high interest payouts. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. Here's the explanation. The best answer is option B. ETF wrapper target date funds and broad index ETFs are typically more tax efficient in taxable accounts because they either minimize turnover or use in-kind creation and redemption to avoid distributing capital gains. To synthesize our discussion, remember these key points. Traditional TDFs in taxable accounts often create annual taxable distributions. Those distributions add to your income with no deferral, reducing after-tax returns. In taxable accounts, prefer ETF wrapper TDFs or broad, low turnover index ETFs. Place bond-heavy assets in tax-advantaged accounts. Rebalance within tax-advantaged accounts or with new contributions. And review your 1099 DIV each year to keep tabs on tax drag. As we conclude, the bottom line is straightforward. Avoid holding traditional target date mutual funds in taxable brokerage accounts because the annual tax drag is real and persistent. Use tax-advantaged accounts for TDFs and bonds. In Taxable, prefer ETF wrapper TDFs or broad, low turnover index ETFs. Keep your approach simple and tax aware, and review your 1099 div every year so you can adjust before small leaks become big losses. Finally, thanks for watching. If this helped clarify why your brokerage account might be bleeding money from taxes, please like, share, and subscribe. I'd love to hear your experience with target date funds and taxable accounts, so share your thoughts and questions in the comments. Until next time, invest tax smart and stay informed.